Okay, in this lecture, what we will do is we'll explore a source of financing for companies called hybrid financing. Okay, recall then when we talk about financing, okay, so when we talk about financing, the traditional sources of financing are what? The traditional sources of financing are debt and equity. Okay, so what is debt? Alam nyo na yan. Debt is indebtedness, pagkakautang, no? Loans. Okay, and equity, on the other hand, represents investment by owners. Okay, and so these are the two traditional sources of financing. Okay, what we will discuss today is a third source called hybrid financing. Okay, so I'm saying that it's a third source because later you'll understand that it is the kind of financing that is in between debt and equity. Sometimes this is called mezzanine financing. Mezzanine kasi it's in between the first and the second floors. It's in between equity and debt. Okay? And that class of financing is called hybrid financing. Okay? So that's what we'll explore in this lecture. So what is hybrid financing? Hybrid financing can be defined as sources of finance that have characteristics of both equities and debt securities. So so that's why it's called hybrid kasi this issuances has the characteristics of equities and debt. What are the characteristics of debt? Okay. So when we talk about debt, anong characteristic ng debt? There is interest, right? And there is obligation to repay. Okay. And because there's an obligation to repay, the interest is also fixed or as stipulated, meaning there is no upside na mag-accrue sa lender. Okay? On the other hand, what are the characteristics of equity? No, equity is there is no interest, merong dividends, but dividends are discretionary. Meaning there is no fixed amount of dividends every time. It could be zero, it could be so high, or it could be very low. No, and there is also no obligation to repay the investors of their investment, right? However, they participate in the upside. No? So kung lumaki yung value ng company, all of a sudden, all that value increase will accrue to equity and not to debt. So essentially, those are the characteristics of debt and equity. So when we say hybrid financing, no, hybrid financing are a class of instruments which combine the features of pure typical equities and pure typical bonds. Okay, something that combine the two, na may interest pero may upside. Okay? Or equity siya pero fixed ang interest. Or may fixed dividends na pinapromise. So those are called hybrid securities or a source of hybrid financing. Okay? Now, the classic type of hybrid financing are called convertible securities. Parang sila yung classic types of hybrid financing. So parang sila yung foundational type of hybrid financing. So in general, it refers to both convertible bonds and convertible preferred shares. And when we say convertible, what does it mean? Okay. It allows investors to convert their fixed income investments into pre-specified amounts of the issuing firm's common stock. So if you would imagine, if you are the investor and you own a convertible bond, for example, when you obtain the convertible bond, you have a bond, right? And therefore, it pays interest and you can get the principal. However, you also have a chance to convert it to equity. Meaning you want to exchange your bond, ayoko na pala ng bond, gusto ko shares na. Pwede yun, right? And when you do that, you can now participate on the upside, right? And so therefore, it gives you the characteristics of both equities and debt. Okay? And so therefore, the most classic type of hybrid financing is convertible securities. There could be other types of hybrid financing that are way complicated, no? And that is yung tinatawag na financial engineering actually pertains to the design of different types of securities, right? So that it can suit to the different um, wants and needs of investors. No? So those are things to look into. So when we talk about hybrid financing, no, or convertible securities, what are the terms that we need to understand? No? So first, when we talk about convertible issuances or convertible bonds, you need to understand that it is just like a normal bond. Okay? So if it's a convertible bond, it's similar to a normal bond. And so therefore, these three things are something that you'll expect in a convertible security or a convertible bond. Number one is the principal or the proceeds. The proceeds is the amount of money borrowed and received by the issuing firm. Okay. In the world of convertible securities or hybrid bonds, no, there is another term called par value, and it is synonymous to what's called the maturity value. So the principal value or proceeds as opposed to maturity value is the amount to be repaid by the firm at maturity. So the amount that you receive is not necessarily the amount that you will repay, right? Because it can be different. Under what circumstances will it be different? Now, for coupon bonds, where the yield to maturity is equal to the coupon rate, the maturity value is equal to the principal. However, if the yield to maturity is not equal to the coupon rate, then the maturity value is different from the principal. Recall, what are coupons? Okay. Coupons are fixed interest payments made by the borrowers to the lenders. For example, a bond may be worth 1 million pesos. That's the par value. Okay. The coupon rate might be, say, 12%. Ano ibig sabihin ng coupon rate? It means that magbabayad ng 12% na interest. So that's 1 million times 12%. So that's 120,000. That is the fixed interest payment that's going to be uh, to be uh, to be paid by the borrower to the lender. Okay. However, yung yield to maturity might be different. Okay. So if the yield is different, say 11% or 13%, which is different from 12%, right? Then the maturity value will not be equal to the principal. We'll demonstrate more of this later. Okay? So let's park this and you will see this in the example later. Okay? Now, another thing is there could be zero coupon bonds. Ano ibig sabihin ng zero coupon bonds? No? These are bonds wherein there is no coupons. Zero ang coupon. Right? So therefore, it does not pay interest. Okay? In this case, the maturity value is always higher than the principal. Okay? Because the difference between the maturity value and the principal refers to the interest that needs to be paid. Okay? Kasi there is no coupon that is paid regularly. Okay? And as you know, maturity refers to the date when the debt has to be repaid. So those are terms similar to a usual bond. Now, what's different in terms of the convertible issuance terms? Ito yung different for convertible bonds. Okay? Merong tinatawag na conversion price or conversion ratio. So the key principle in convertible securities is that it has the ability to convert. Now, the investors have the ability to convert their convertible securities into equity. Okay, from convertible bond to equity. Essentially, that is the key feature of a convertible bond. No? So to be able to execute that, to execute such conversion, dapat alam natin how do we then convert our bonds to number of shares. And usually there is a price that bridges the two, or a ratio that bridges the two. Because the conversion price or the conversion ratio must be part of the terms of the security so that we can determine how we will convert from debt or equity. Okay? Now, the conversion ratio, the conversion can be in terms of a conversion ratio or in terms of a conversion price. Conversion ratio or conversion price. If it's a conversion ratio, it is defined as the number of common shares that each bond could be exchanged for. Okay? So for example, that ratio can be 20:1. How do you interpret that 20:1? So for example, if a bond with par value of 1,000 can be converted into 20 shares, 20 equity securities, then the conversion ratio is 20:1. Remember, for example, meron kang 1 million bond kanina in total. Remember, are bonds are pieces of paper, right? Which says that the bearer of this bond, no, parang may pagkakautang yung issuer to the bearer of this bond. Okay? And bonds are segregated into denominations. Okay? So yung 1 million mo na total bond, na total amount of the bonds, pwedeng segregated yan into many pieces of paper na worth 100,000 each. Right? And therefore, you will have 10 pieces of bonds para mabuo mo yung 1 million na total bond value that you have. Okay? So this piece of paper, this is called one bond. And that bond or bond indenture is worth 100,000. If you're telling me that you have 1 million worth of bonds, therefore you have 10 bonds. Okay? So that in total, it will be worth 1 million. Okay? So the conversion ratio simply means that each bond, each paper, can be convertible into how many shares of stock. So that's the interpretation of a conversion ratio. So if it's 20:1, one bond is equal to 20 shares. And that's how you convert between bonds to number of shares. Okay? Right? In this case, let's assume that each bond is worth $1,000. Okay? And you have 1 million worth of bonds. If that's the case, if you have 1 million worth of bonds and each bond has a par value of $1,000, how many bonds do you have? It means you've got 1,000 bonds, right? You have 1,000 bonds, right? Since you have 1,000 bonds and the conversion ratio is 20:1, okay, which means your 1,000 bonds is equivalent to 20,000 shares. And that's how you convert from number of bonds to number of shares through a conversion ratio. Okay? Now let's look at conversion prices. Okay? The way we convert can be also in terms of a price. Okay? When we say conversion price, it is the price that you should pay for each common share upon conversion. Right? So, for example, you've got bonds worth 1,000. Ang sabi sa'yo, the conversion price is 100. So, this is the bonds. And then conversion price is $100. Okay? Which means your $1,000 worth of bonds can buy how many shares? It can buy 10 common shares. Okay? So yung kanina, 1 million worth of shares, right? If you're telling me that the conversion price is $100, so that's 1 million divided by 100. That amount is the number of common shares that you get from conversion. That's how you apply the conversion price. Okay. As a general rule, the conversion price is equal to par value over the conversion ratio. Okay. And that's how we determined it here. The par value is $1,000 and the conversion ratio is 10 common shares per bond. And that's how we got the implied conversion price of $100. Okay, under the second example. Okay, so that's how we determine the conversion price. So these are very important terms that are critical, towards the analysis of convertible bonds. So at a convertible's maturity, and it is profitable to exercise the bond's conversion port option if the issuing company's share price traded higher than the conversion price. What do we mean by this? Just like any other option, it depends on the price of the underlying asset, whether it will be beneficial to convert to equity or not. Okay. Now, if right before the maturity, the convertible's bond conversion price is say $100 per share, and the shares are trading at $120 per share, do you think it will be beneficial for the investor to convert their bonds from bond to equity? Yes, because if they convert, they are going to effectively be buying those shares at $100 per share. And since these shares are trading at a higher price, 120, then there's a payoff for them. Okay. So in terms of a convertible bond, you have to realize, okay, that in a convertible bond, actually, it is a bond plus merong nakakabit. There's an embedded conversion option. Okay. So that conversion option is actually the investor's option to buy the shares of the issuing company at a certain price. And since it's an option to buy, it's a call option, right? And since they have the right to exercise that option, that's called a long call option, right? So essentially, the conversion option is an investor's long call option on the shares of the issuing company. And what is the strike price? The strike price is the conversion price. Okay. Thus, if you look at it, in terms of decomposition, okay, a convertible bond is actually a combination between a straight or regular bond plus a long call option on the shares of the issuing company. Kaya rin ang tawag sa mga ganitong securities, they're also called complex securities. Why are they complex securities? Because two independent securities, a bond and an option, are combined into one. Okay, so hybrid securities are frequently also called complex securities. Okay, so this is a very important realization for us that a convertible bond is actually composed of a straight bond, a regular bond, because it has the characteristics of a regular bond, plus an option, to buy the shares of the existing company. Okay. Now, also some convertible securities has what's called a call provision or an optional redemption provision. Okay, so a bond may also be callable or redeemable. If a bond is callable, the issuer has the right to redeem the security, and once the security is redeemed, essentially there is forced conversion to equity. Okay? So a convertible bond, di ba, is a straight bond plus a call option, long call option. Right? But at the same time, sometimes there is also an option to redeem. Okay? Which essentially the issuer has the right to redeem that security. Okay. So that call provision is usually available at a particular date or at a particular date after. Okay. That's called the call schedule at a particular conversion price, which may be the same from the regular conversion price. It could be different. Okay. And even though sabi ko forced, di ba? In reality, hindi naman forced, but they can force investors to think about redemption or think about conversion. Because usually investors pa rin naman retain the right not to convert. So if you call it, parang sinasabi mo sa mga investors na, oh, willing akong mag-redeem ngayon. Gusto niyo na bang mag-redeem? Gusto niyo na bang mag-convert? Okay? And sometimes the conversion ratio during redemption is better than the conversion price at the end of the bond. Okay? Another usual common term is subordination, which refers to the hierarchy of the application of payments upon liquidation of the company. Okay? And convertible bonds are frequently ranked above common shares but below senior debt. Okay? Since it has the characteristics of both debt and equity, pagdating sa hierarchy of payments, in between debt and equity rin siya. Okay? So, therefore, if you look at the value of a convertible bond, okay, since we can characterize it as a combination, no, of a straight bond in a long call option, then in terms of valuation, you can also think of it that way. Okay? That the value of a convertible bond is equal to the value of a straight bond plus the value of a call option. Okay? Kasi yun ang components niya eh. So the value of a convertible bond is equal to the value of a straight bond plus value of the call option. Okay? Right? How do you value the straight bond? So it is the present value of the cash flows of the bond using the yield to maturity of a straight bond with similar risks. We'll explain that further later. Okay? And how do you value the call option? Just like any other option. You can use binomial pricing model or you can use the Black-Scholes model. So if you get this and you get this, then you get the value of the bond. Okay? And since this is an equality, right? If you know the value of the convertible bond and you know the value of the straight bond, you can also get the value of the call option, right? So this relationship is a true relationship that you can use to get the value of each components in that equation. Okay? So let's look at this. No? Now, given this, why should companies use convertible bonds in financing? Okay? Sino-sino ang gumagamit ng convertible financing? Number one, those issuers that are perceived to be risky. Okay? That's number one. Perceived as risky. Number two, whose risk is hard to assess. Okay? And number three, whose investment and financing policy is hard to predict. Okay? So what are some examples of this? So for example, you are a tech company, tech, young, small, high growth companies. Okay? Tech, young, and small companies are always perceived to be risky. And so, nahihirapan silang mangutang. Right? It's difficult for them to get straight bonds or normal financing. Right? And they don't want to raise equity necessarily. Kasi pag equity ng equity yung raise nila, nadadilute yung original owners of the business. Okay? So, they also don't want to raise so much equity successively. Right? Baka dumating na sila sa point that they could not give up the dilution already. Diba? And so therefore, they might need debt, but they are not qualified, okay, to obtain straight debt because they are perceived as risky or their risk is hard to assess, just like tech, young, small companies. Okay? And so therefore, one middle ground is for them to obtain convertible bonds or to finance through convertible bonds. Kasi habang hindi pa nagko-convert, they benefit from the fact that the cash flows are debt-like, right? However, kung hindi na sila makabayad, they always have the option of converting to equity later on. So it's beneficial for them, diba? Because they can, it behaves like a bond under circumstances that it is that you want it to behave like a bond. In instances that you don't want to be a bond, you can always force redemption so that those holders of convertible bonds will convert to equity. And therefore, nawala na yung risk ng being a bond. Okay? So that's why 1 and 2 are the usual types of corporations who are who would be considering convertible financing or convertible bonds. Number 3 is companies whose investment and financing policy is hard to predict. Usually, this is because of its high growth nature. Okay? And also for highly levered companies. Okay? If the company is high growth, hindi regular ang investment nila. By hindi regular, hindi maintenance na lang. Right? But really, these are for big items that's hard to predict because it can be pwedeng may malaki silang capex this year, and then because it's tech, they need to adapt next year. So it's hard to predict, di ba, the investment levels. No? And so therefore, it's difficult to maintain a regular debt to equity financing, right? So if you're not sure about whether the nature of your investments is parang attuned to debt or equity, you can use a convertible financing first. And then decide later, I want this to be equity. Force convert. Okay? Or redeem. I want this to be debt. Then do not force redeem. Okay? So that's why it's for high growth companies. For highly levered companies, their financing policy is hard to predict. Right? So because you don't know whether it's going to be higher or lower or maintained. And so convertible financing can be a sweet middle ground. No, and then later when you decide on the proper financing policy, you can convert to debt, you can convert to equity, or you can stay as debt. No? Whatever financing policy suits the company. And therefore, convertible financing is usually not suitable for large, mature companies. Okay, especially with strong credit ratings kasi they can get cheap debt easily. No? And so therefore, mas madali for them to do that. Okay? Those who want backdoor equity financing can also use hybrid financing. Okay? Another reason why hybrid financing or convertibles are advantageous is because it neutralizes information asymmetry on the company's risk. What is information asymmetry? Information asymmetry basically means that the insiders of the company and the investors, which are outsiders of the company, do not have the same level of information about the company's performance. Siyempre, as an insider, mas marami siyang alam. Management knows more about the company than investors. Kasi investors, outsider tayo. Hindi natin nakikita yung day-to-day operations. Right? So, there is asymmetric information in that case. Issuing convertible financing or hybrid securities neutralizes information asymmetry. Why? Okay? For issuers, usually, they perceive the company to have lower risk because they know everything. They know the plans, right? And so from their point of view, low ang risk ng company. Okay? But from outsiders' point of view, a company's perception of risk will be higher. Okay? Now, let's look at the impact of the risk perceptions. For an insider, low ang risk perception niya about the company. And therefore, from his point of view, mababa ang interest rate ng bond. Right? Kasi the interest rate reflects risk. So if low risk, low interest rate rin. Okay? And if low ang interest rate, the present value of the cash flows of my bond will be high. Right? And therefore, the value of the straight bond is high. Okay? Now, if the risk is low, the conversion option will have a low value. Remember, in an option, as volatility increases, the value of the option increases also, right? So from the point of view of an issuer, the value of the bond component of the convertible bond is high, but the value of the conversion option component of the convertible bond is low. Okay. Now, let's take the point of view of outsiders. Okay. From outsiders, the risks are relatively higher kasi hindi nila alam yung buong kwento. Right? And because of that, their perception of the interest rate of the company is high. Okay? And therefore, kung mataas ang interest rate, mataas ang discount rate, the value of the bond is lower from their point of view. Okay? Now, if the risk is high, volatility is high. And therefore, the value of the bond is high. The value of the conversion option is high from the point of view of outside investors. So kung napansin nyo, ang nangyari sa investors, low value plus high value ng option. So parang nanoneutralize yung information asymmetry. So kahit magkaiba sila ng alam, pero different components of the convertible bond reacts differently and offsets each other. And so therefore, all in all, no, the information asymmetry will be neutralized or will be counterbalanced. Okay? By the fact that a bond and a conversion option is combined in one security. Right? Let's have a numerical example. No? So for example, a firm issued convertible securities with a par value of $1 million and a coupon rate of 10%. Coupon par value. Okay? The interest is payable annually until its maturity in 5 years. So 5-year yung bond. Okay? When it was issued, the yield to maturity was 9%. Okay? So a similar conversion-free bond or a straight bond, okay, with the same risks as the firm and similar terms yielded 11%. So ang tanong, determine the value of the conversion option. So what we'll do here is we will be using this equation. Value of the convertible bond is equal to the value of the straight bond plus the value of the conversion option. So solving for the conversion option, the value of the convertible bond minus the value of the straight bond should be equal to the value of the conversion option. So let's try to get these values. Okay. How do you get the value of the bond? Okay. The value of a bond, okay. So value of a bond is equal to the present value of its cash flows discounted at the yield to maturity. So essentially, kukunin mo lang yung present value ng lahat ng cash flows ng bond, pero ang discount rate na gagamitin mo is whatever is the yield to maturity. Okay? Ang sabi sa'yo, the yield to maturity of the convertible bond was 9% here. Okay? And the yield to maturity of a normal bond is 11%. So if i-present value mo yung cash flows ng bond at 9%, you can get the value of the convertible bond. And then if i-present value mo yung cash flows ng bond using 11%, makukuha mo yung value of a straight bond. And the difference between the two, that is the value of the conversion option. Okay? So how do you do that? The first thing that you need to do is to lay down the cash flows. So we got meron tayong years 1, 2, 3, 4, and 5 here. We need to lay down the cash flows of the bond. What are the cash flows of the bond? The first is the principal. Okay, sorry, the par that needs to be paid. Okay, the par is 1 million payable on the 5th year. Okay, and then coupon bond daw ito, ng bond coupon rate is 10%, which means the interest that needs to be paid will be 1 million times 10%, So that's 100,000 per year. Okay. So therefore, the cash flows wise, 1 million, 1 million, 1 million, 100,000, 100,000, 100,000, 100,000, 100,000 for 5 years. When you add the two, then these are the cash flows of the bond. All right. Now, all you need to do is to get the present value. How do you get the present value? In the present value formula, right? What's the present value formula? Let me just erase. Okay, so the present value is the cash flow divided by 1 plus the interest rate raised to n, right? So if you look at the first year, this one, this will be 100,000 over 1 plus the yield to maturity. The yield to maturity is 9% for a convertible bond raised to the first power, and that is 91,743. Sa year 2, the same, pero years raised to the second power. Okay, so that is equal to 84,168. So you do that for every year, then sum them together. The value of a convertible bond is this, 1.038 million or 1.039 million. Okay, so alam mo na ito, itong component na ito. Right? You just need to get the component na value of a straight bond. Okay? To get the value of a straight bond, it's the same cash flows, but a different yield because a straight bond will be priced differently. And the yield of a straight bond is 11% in this case. Okay, so anong gagawin mo? Kukunin mo uli yung present value ng bawat isa. However, the present value the discount rate will be 11%. Dito ang discount rate 9% kasi yun ang yield to maturity ng isang convertible bond. Ito sa baba, 11% kasi yan ang yield to maturity ng isang straight bond. Okay? So just get the present value and its amount is 963,041. And so therefore, to get the value, how much is the value now? Okay? Of a convertible bond. Okay? So the value of the convertible bond's value is 1,038,897. The value of a straight bond is 963,041. So the difference between the two is the value of the conversion option. Okay. So that is how much? Let me calculate. So the value is, 1038 minus 963. So that's around, that will be around 75,855. That is the value of the conversion option. All right. So that's one example that we are studying. Okay, let's have a second example. Now let's assume that the same bond was issued. The par is 1 million. Composed of 1,000 bonds worth 1,000 each, $1,000 each. Same coupon, same everything. Okay. The question is determine the number of shares converted at the following scenarios. Okay. So you know that the par value, total par value is 1 million. Par value of one bond is $1,000. And therefore you have 1,000 bonds. As in bond indentures or papers of bonds with you. And the current share price is $70 per share. Okay? The first scenario is determine daw natin ang number of shares converted. Okay? Using each of the following scenarios. Scenario A is that the conversion ratio is 15:1. Okay, so 15:1. That's the conversion ratio. Okay? So based on the information, you own 1,000 bonds. How did we get that? the total bonds that you have is 1 million divided by the par value per bond is $1,000. So therefore, you have 1,000 bonds. Okay? You have 1,000 bonds and then your conversion ratio is 15:1. So multiply that by 15 and therefore, when you convert, you will receive 15,000 shares. Okay? How much is the share equivalent of that? Okay? So that's 15,000 shares times the current share price of 70. Right? Effectively, when you convert, the value of shares that you will own is worth $1,050,000. Okay? Notice that the value of the shares owned, 1,050,000, is higher than the value of the bonds. Right? So in that case, you are incentivized to convert at this price, at this conversion ratio. Right? Because the value of the shares that you will own is higher than the value of the bond if you just let it be paid. Okay? So that's scenario A. Let's look at scenario B. For example, the conversion price is $68 per share. Okay? So now, hindi mo na titingnan yung number of bonds owned. You need to determine, ang basis na niyan is the value of the bonds that you own. Okay? Now, the value of the bonds that you own is $1 million. Para malaman mo kung ilang shares bang mabibili niyan, right? So you have to divide it by the conversion price. In this case, the conversion price is 68. Okay? Given that the conversion price is 68, therefore you can buy 14,706 shares. Okay, so that's 1 million divided by 68. No? If you multiply that, 14,706 times $70 per share, which is the current share price. Okay, the value of the shares that you will own is 1,029,000, which is higher than 1 million, right? And so therefore, under scenario B, you will be incentivized to convert, right? Because the value of the shares that you'll own after conversion is higher than the value of the bonds that you're owning. Okay? And so therefore here, the decision would likely to convert. All right? So scenario A din. You will be incentivized to convert. Let's look at scenario C. Okay? The conversion price now is higher, 72. So your 1 million pesos, if each share is worth 72 dollars, each share, you can only buy 13,889 shares. And if you get the total value of that, 13,889 shares times $70 per share, it will give you 972,222 as the value of the shares that you own. Notice that that's lower than the value of the bonds owned, right? Therefore, under this circumstance, the investor will be incentivized to not convert. Because the value of the shares after conversion is less, right, than the value of the bonds. So I'll just let him pay me 1 million rather than convert it to equity. Okay? So, parang kung titingnan mo under scenarios B and C, okay, your strike price in this case is 68. In this case, 72. And your spot price is 70. Right? So just like a normal option, right? Since you have an option to buy shares, under scenario B, the exercise price is 68, the spot price is 70, you have a payoff of $2. And so therefore, you will exercise the option. Okay? Under scenario C, the exercise price is 72, the spot price is 70, and therefore the payoff is 0. You'll just let the option expire. Okay, so the principles of options still exists. Okay, so that's very critical in the study of convertible securities. Okay. Lastly, I want to show you some other examples of convertibles. We're not going to study them in detail, but these are some examples. One type of convertible security is called Lion or liquid yield option notes. Okay. What are the characteristics of a Lion? It has 0 coupon. And it has an embedded put option to sell the note to the borrower at a price equal to the note's original value. So here, there's a put option specifically on what? Specifically to sell the note itself. Okay? So pwede niyang ibenta yung note to the borrower. So therefore, there's protection, right? Kung masyado nang mababa yung price noong note, pwede niyang ibenta to the borrower at a specified price. So that's a lion. Another is called PERCS, or Preferred Equity Redemption Cumulative Stock. It's simply a convertible preferred share, convertible to common stock. However, the conversion is mandatory at the end. Okay? So walang option, essentially. No, but a forced conversion. So rather than an option, there is another derivative called a forward. Okay, so we weren't able to discuss forwards, but it's also a type of derivative security. Okay, and since mandatory yung conversion, usually nai-incentivize ng higher dividends yung holder ng perks. Okay, prides naman is similar to perks. Prides is preferred redeemable increased dividend equity securities. Similar to perks, higher dividends din, pero hindi mandatory yung conversion. Pero the conversion will be at a loss. Right? A pre-specified sliding scale na a loss. So if you're willing to hold the loss, then you may still convert if you want to. Okay? Something similar to that. And there are a lot of other types of securities that are being designed. It depends on the appetite of investors. It depends on the need of the issuing company, no? And we cannot study them all, but I guess just to give you an overview of the different samples. Okay, so that's it in terms of hybrid financing. Thank you.